Something just broke, and it didn't break slowly. It snapped, quietly at first, then all at once, and your money is sitting right in the middle of it. This is not one of those stories that unfolds over months or years. This is a today's story, a now story. The kind that hits while most people are still scrolling and assuming tomorrow will look like yesterday. Banks tightened something behind the scenes, and the moment they did, a massive wave of money moved. You weren't notified, you weren't warned, and no alert popped up on your phone to tell you what just changed. Gold didn't drift higher. It didn't creep. It broke out, violently, like a pressure cooker, finally giving way after being sealed too tight for too long. When assets move like this, it's not because of optimism. It's because someone is scared. Someone with a lot more money and a lot more information than the average person. Your savings account looks calm. Your retirement balance looks normal. That's the trap. This is how danger shows up in financial systems. Not with sirens, but with silence. By the time the headlines catch up, the exits are already crowded, and the rules are already different. Something shifted just now, and it wasn't for your benefit. It was defensive, urgent, and it signals stress deep inside the system. You can feel it if you know what to listen for. Tighter credit, sudden policy moves, assets that haven't moved in years, suddenly exploding upward. This is the moment before confusion turns into panic. The moment when people still think they have time, even though time is exactly what just ran out. No one rang a bell to tell you the game changed, but the market did, and gold just shouted what banks are too afraid to say out loud. When money moves this fast, it's never random. It's coordinated, reactive, and driven by institutions that operate above the public narrative. Banks don't tighten because they feel cautious. They tighten because they see risk forming where the public still sees stability. Central planners, regulators, and policymakers all speak in calm language, but they act in sudden motions. That gap between what they say and what they do is where crises are born. Every major financial collapse in history followed this exact pattern. Quiet restrictions first, reassurance second, and chaos last. The system isn't designed to protect individuals. It's designed to protect itself, even if that means locking people inside when pressure builds. When banks tighten lending, reduce exposure, or change internal rules, it's not about discipline. It's about survival. Gold breaking out at the same time is not a coincidence. It's a signal flare from the people who understand what tightening really means. This is the same behavior seen before currency resets, before debt crises, before confidence evaporates. Money doesn't wait for confirmation. It moves at the first scent of smoke. Power figures never announce the fire. They announce temporary measures, precautionary steps, and strong fundamentals. But markets don't listen to speeches. They listen to stress. Right now, the system is blinking red, and the people closest to the controls are quietly repositioning, while everyone else is told to stay calm. That disconnect is where fortunes are either lost or preserved, and it's widening by the hour. Here's where the story takes a turn that almost no one expected. The tightening wasn't triggered by collapse, but by fear of what might break next. It changes everything, because it means the system is acting preemptively, not reactively. And preemptive moves often create the very panic they're meant to prevent. Some insiders believe this move stabilizes the system. Others believe it accelerates the unraveling by freezing liquidity at the worst possible moment. Gold's breakout adds another layer of confusion. Is it a hedge, a warning, or a countdown? If this is protection, why does it look so aggressive? And if it's fear, what exactly are they afraid of right now? There's a rule in markets that most people forget. When safety assets move first, risk is already inside the building. The question no one wants to answer is whether this tightening stops the bleed or triggers a chain reaction. And the market is split, violently. Some see control returning. Others see the doors closing. Both can't be right, but both groups are moving money like they believe time is limited. That's the danger zone, when even the experts stop agreeing and start hedging against each other. Let's slow this down for a second and look at history. Tightening has happened before, and sometimes it worked. There were moments when pulling back credit cooled inflation, stabilized currencies, and restored confidence. That's the logic, and it sounds comforting. But those moments only worked when the system wasn't already overloaded, when debt levels were manageable and trust still existed. This time is different, and that phrase is dangerous for a reason. The system is carrying more leverage, more promises, and more invisible obligations than ever before. When you tighten into that environment, you don't release pressure. You redirect it. Markets respond emotionally, not rationally. Fear doesn't disappear. It looks for an exit. Gold breaking out is not about returns. It's about escape. The deeper threat isn't a crash tomorrow. It's a slow grind where access, liquidity, and freedom quietly erode while prices tell you everything is fine. That's how people get trapped, not by collapse, but by normalization of restriction. By the time fear becomes obvious, the options are already gone. This is the moment where the story stops being about them and starts being about you. Not as a victim, but as someone paying attention. Most people outsource thinking to headlines. Smart money watches behavior. There's a psychological shift that happens when you stop asking if the system is safe and start asking how it behaves under stress. That's where patience becomes a weapon, where discipline matters more than speed. The public reacts late. Insiders position early and wait. This isn't about panic buying or emotional moves. It's about understanding the battlefield and not standing in the kill zone when rules change. The people who survive financial shocks aren't the loudest or the fastest. They're the ones who prepared quietly while others argued about whether anything was wrong. Right now, positioning matters more than prediction, and awareness is the rarest asset of all. What happens next depends on whether tightening continues or snaps back, and that decision may already be in motion. Gold's move may be the first domino, not the last. Other assets are watching, waiting for confirmation. There's one area of the market that reacts next when this pattern appears. It doesn't move slowly, and it doesn't warn. If that move starts, the narrative changes overnight. And the people who saw this moment will understand why it mattered. This story isn't finished. It's barely begun. And what comes next will decide who was early and who was trapped watching it happen.